Hi, this is Todd Baker, your certified mortgage planner, and I wanted to send you a series of videos, really educational videos, because what I've found is most of the agents I work with really need a better working knowledge of the loan types so that you can incorporate those into your initial buyer consultations, so you can sort of get a feel for where they're at and know where know where they can sort of go before you give them over to me. And so what I want to talk today about is conventional loans. We're going to talk about what they are, what the pros are, and what the cons are. And then stay tuned, because next week I'm going to go over FHA. So first, a conventional loan. Conventional loan is a Fannie Mae or Freddie Mac loan. The loan limit amount is $417,000. And the biggest thing to know is owner-occupied second home and investment property. So whenever you're a client that's looking to buy a rental property, one of the first things you want to ask, for example, is, what kind of down payment you want to put down. So I had one this week where the borrower wanted to buy 2 duplexes and put just like $150,000 duplex. Minimum down payment was, actually in a duplex it's 25% down, single family was 20% down, and she had gotten information that she could put like 5% down. It just wasn't going to work, so we're sort of retooling her strategy. But make sure you're asking if it's an investment property. Next, there is a 3% down program that you'll hear advertised for conventional, but there's a caveat to it. And I really don't like the program that much, because what it does is, because it's a higher interest rate, the market, a lower down payment, the market demands a higher interest rate. So there's adjustments to the rates. It's a higher interest rate and much higher mortgage insurance premium that the client pays monthly. So usually it's not the best option. Next is the MI premium. You will have an MI premium based on your FICO score for anything for less than 20% down. And then 5% down is the minimum, or really the recommended. 3% is the minimum, 5% down is usually the one that's recommended, that I recommend. And because you get the market rate, meaning you're going to get the interest rate based on your FICO score and not pay that higher rate for just a few percent less down. And also you're going to have a lower mortgage insurance premium. So let me go over the pros and cons real quick with you. Number one, there's no upfront mortgage insurance premium. And what that means is a better equity position. So on all the government loans, which we'll go over the next few weeks, they require either an upfront mortgage insurance premium or a funding fee. And that means a higher loan amount and thereby less equity. So one of the advantages right out of the gate is that 5% down, if that's how we go, it's a pure equity position. The next thing is the mortgage insurance premium cancels at 78%. On a 30-year fix, that takes 11 years. But I teach my clients to pay a house off very quickly. So what ends up happening is the MI will cancel much sooner. And if the house appreciates, between appreciation and paying the mortgage down, if it's before 78%, if there's 20% equity, the client can request our servicer to order a new appraisal, and if it comes in with 20% equity, it will actually be removed. So that's a big bonus. Next, this is a big one. If you have a client that says, hey, I'm great, but my wife, or it might be my husband or my spouse or whatever the situation may be, she works or he works, but they don't have good credit. The credit's horrible. For government loans, you have to include non-purchasing spouse liabilities into the debt-to-income ratio of the borrower without using their income. So that could create a problem. You don't have to do that with conventional. So if they can qualify for conventional, it's a great bonus. Next, and this is a big, big thing, you always hear 2 years self-employed, 2 years self-employed. You have to have 2 or more years for self-employment, but we actually have a program for 1 year's tax returns we can qualify off on. That's a real big deal. So if you have a client that said, hey, I'm self-employed, last year I did great, have them give me a call, we can probably help them. And finally, let's look at the cons. Cons are, Fannie Mae, it's a FICO score driven model, and what that means is there's little different buckets. 740 and above is really prime rate, 720 to 740, there's a little bit of adjustment, 680 to 719, another adjustment, and then under 660, and here's the big thing, under 660, it's usually better to go FHA, because the adjustments to the interest rate and the mortgage insurance premiums are typically way higher than you would be for FHA. And those are the kind of things I look at as a mortgage planner for your clients. I'm going to look at putting them in the best loan program with the lowest cost, and then I'm going to teach them how to save tens of thousands of dollars over the life of their loan. So hope you find this helpful. There's some bullet points underneath the video, and call me anytime with questions or help. Have a great day.